Accrual and prepayments adjusting entries. Well, you might ask, what is an accrual or a prepayment? Well, an accrual is the accumulation or increase of something over time, while a prepayment is a payment usually made earlier than the scheduled date. So, with that being said, we're going to get in how to adjust those entries accordingly. For transaction number one, we're dealing with accrual style adjusting entry, more specifically, supplies expense. An adjustment entry for supplies is necessary at the end of a fiscal period to accurately reflect the amount of supplies that have been used during the period, typically from day to day operations. When supplies are purchased, they are initially recorded in the supplies account as an asset. However, as they are used, they become an expense, entering the supplies expense account. Without adjusting for the amount used, the balance sheet would overstate assets and the income statement would understate expenses, leading to an inaccurate net income and an incorrect financial position of the business. As you can see here, I used the magic number of 3,825 in my transaction. How I achieved this number was by taking the supplies on hand from the trial balance, 4,455, and subtracting 630, which left me with 3,825, which is the difference between the two numbers. By taking away that number, it will get us down to the supplies we have on hand by crediting the supplies account. And by finishing off the transaction by debiting supplies expense, so then it will go on our income statement. For transaction number four, we're dealing with a prepayment. According to the adjusted trial balance, the company had $25,000 worth of unearned revenue, but according to the transaction, all but $4,500 of these services have been provided. So, an adjustment entry for unearned revenue is necessary at the end of a fiscal period to recognize the portion of revenue that a business has earned. When a business receives payment in advance for goods or services, it records it as a liability in the unearned revenue account because the service or product hasn't been given yet. As the business completes the task at hand, a portion of that unearned revenue becomes earned and should be recorded as a revenue in the service revenue account, or whatever depends on what the company is doing. Without this adjustment, liabilities on the balance sheet would be overstated and revenue/profit on the income statement would be understated, leading to inaccurate financial statements. I got the magic number of 20,500 from subtracting 4,500 from 25,000. Then I debited the unearned revenue account to recognize the revenue that we completed and remove it as an obligation. And finally, I credited the service revenue to actually recognize what we did and put it on the income statement. And finally, for transaction number five, we're talking about another accrual, this time interest. An adjustment entry is necessary to record interest on a note payable at the end of a fiscal period to ensure that all expenses are incurred are properly matched with the revenues of that period. Even if the interest hasn't been paid yet, it is still accumulated or accrued during the time and is an expense of the period. Failing to record it would understate the expenses on the income statement and liabilities on the balance sheet, once again resulting in inaccurate financial statements. I got the number of $877.50 by taking the notes payable of $162,000, dividing it by the 6.5% annual interest rate, and dividing it by 12 to find the monthly. Since this transaction says that the interest is paid monthly, we only need to account for 1 month. So I debited interest expense so it would go on the income statement and show that we used the expenses for this period and possibly take away from any other revenues that we may have generated. And then I credited interest payable because in this case, tomorrow we would be paying that. So instead, we would debit interest payable and credit cash to show that we accounted for it in this period. By using certain principles, we can identify how these adjustment entries can be made. In all, these adjusting entries help us find the proper financial position of a business and make sure users know what they're actually looking at when they're looking at a business's financial statements and not making any guesses and can also make educated decisions.